This will be the only video you'll need to know if Meta stock is a good buy for you. So Meta stock has been down recently and you're probably waiting on the sidelines wondering if it's a good time to enter. Looking at the past 4 years, the stock 6x'd. So let's take a look. We're going to fire up the spreadsheet for this one, but don't worry. There's no math involved. It mostly just boils down into your assumptions about the future of Meta's business. Now, it's important to note that Meta's core business is advertisements. 98% of the revenue comes from ads. It's been a stable, cash flow generating business, and Wall Street likes that. It's easy for their projections, but Zuck has a tendency to experiment with things, especially as of late. In 2021, going into 2022, Zuck did a whole rebranding pushing the metaverse. And as a result, the Reality Labs portion of Meta's business saw tens of billions of dollars in losses. This shook investors, and as a result, the stock fell upwards of 70% at one point. Since then, it's 6x'd, and whatever drop Meta had seems insignificant at this point. There's a lesson in this. Wall Street is very myopic. They have a tendency of just looking for the next quarter. And in the case of Meta, these analysts were basically assuming that the Reality Labs capex of $10 billion is going to continue in perpetuity. And of course, with those assumptions, all of your models break down and it would make sense for Meta to be a 20 PE ratio company. Except Wall Street took it even further. It even dropped 50% from then. And at that point, it was reaching 10 PE ratio region, which is an absolute steal. At that point, they're assuming that the business is in a structural decline, which wasn't the case at all. Fast forward to 2024, 2025, they cut down their capex, obviously. There's no reason for them to continue. And the stock shot up like 6x. And also from that spending, we got the Meta Ray-Bans, which people have their different opinions on it, but I personally think they're all right. But now in 2026, it looks like the same narrative is coming back, this time with AI capex. So Meta has been aggressively investing into AI, but it seems like nothing seems to be clicking for them. Llama turned out to be a big nothing burger. And they're building out all these data centers and trying to compete with hyperscalers like Google and Microsoft. And they invested $14 billion into Scale AI. And Wall Street is framing it as if it was the worst thing ever. As if Zuck just invested to bring Alexander Wang to work for Meta. As if Scale AI is just a glorified data labeling company. From all of these risks, I think the continued investing to compete with hyperscalers is a risk you should really pay attention to if you want to be a Meta investor. But I think the one saving grace for Meta is that they can stop this capex at any time. The fundamental business is still intact and it's still printing cash. Also, I think it's too soon for you to conclude that there's nothing coming out of these AI investments. I think these AI investments have been making their ad targeting better, thus contributing to their core business. And also just recently, the news came out that they're also starting to sell compute. Now, this gets a bit more complicated because you can argue that compute is a depreciating asset, but I digress. Enough with the background, let's jump into the valuation. I'm going to start with their 2024 free cash flow. And the reason why I'm doing this is because I think that's right before they started the heavy investing into AI infra. So it's a good starting point for the core business. It should probably be a bit higher, in fact. But from there, I'm going to assume a 12% growth rate for the next 5 years, slowing down to 6% for the 5 years after that. And this is a bit more on the conservative side because if you look at their top line right now, they're growing it in the 20s. And I'm going to assume I'll be able to sell the company at 20 times free cash flow in year 10. And historically, this is right about what Meta sells at. With these assumptions, we get a $1.5 trillion market cap, which is right at what Meta is trading at today, which would make it fair value. Now, these models can get really complex, and with the discount rate, there's many ways you can do this. You have WACC, you have CAPM, you have all this. But from a practitioner's point of view, bonds are yielding about 4 or 5%. Add on maybe a 5% equity risk premium, you're at 10%. And if you watch any of Berkshire's annual meetings, you can infer that this is also what Buffett uses, even though he does it all in his head. According to Warren Buffett and practitioners, you don't really need derivative and all this BS to value a stock because ultimately value should slap you in the face. So it mostly boils down into your business acumen. This is part 1, follow for part 2, and leave a comment down below what stock I should cover next. I'm able to do all this research on StockSpill, so check it out.